Right then, straight after the candlestick episode now, going on to liquidity. Now, liquidity is a very, very important concept of trading. It is like the pinnacle of what I need to enter a trade. I need some sort of liquidity sweep or some sort of liquidity to draw towards for my TPs. Um, you know, it's just really important to understand where liquidity lies, um, what kind of liquidity is high probability on your draw. So where does price want to draw towards, like a magnet? Yeah, obviously, what is liquidity first off? Liquidity is normally um, it's basically buy or sell stops of banks, institutions, retail traders that are in, say, a long position from here. Where's this stops gonna be? It's gonna be here. So there's a considerable amount of buy stops here, resting below this low here, because many people would be in buys right now here. Yeah, so there's loads of sell stops here. Sorry, I got confused then. So normally, when it's trading, if you're trading a futures account, if you're in a sell, there's going to be buy stops. If you're in a buy, there's going to be sell stops. So sell stops is your stop loss in the world of trading. Obviously, when you're trading prop firms on CFD brokers, you don't technically use buy stops. They do, but it's also just called an SL. So, but anyway, loads and loads of sell stops would be sat under here. So this would be sell side liquidity. This is where loads of retail traders are holding their stops under. So obviously, if price comes back down, stops them out. That's a liquidity sweep. So if price comes down, say like it did here, so obviously retail traders would be like, ooh, we've had a major sell off now. We've got to go up. We've got to go up. We've got to retrace. They'd enter here like this. Stops underneath this swing low, targeting, probably all the way up. Obviously, we come up, we start to stall out, we come back down, and we sweep liquidity here. We sweep the sell side. That means everyone in along here got stopped out, meaning your liquidity has been swept. Oftentimes, when liquidity is swept, you'll have some sort of reversal, especially if it's the highest draw on liquidity. We normally see some sort of reversal, but obviously buys buys buy stops then with sells. You know, uh, People probably got in here. Yeah, so maybe say people got in here, right? In sells. Even sells here, right? They're thinking, oh, there's we're in a uptrend, we're in an uptrend. It's got to come back down. It's got to come back down. They probably got in a sell maybe here, stops above here, or even stops above this swing high here. Thinking, yep, we've got to come down. We've got to come down. And then obviously liquidity has been swept. All those retail traders got stopped out. This would be buy side. And then after this buy side liquidity got swept, out of all them retail traders got sucked into sells way too early, we then roll over, come back down, and sweep. This low, these equal lows, yeah. Um, so yeah, that's basically what liquidity is and how to spot it. It's basically, using your common sense really. Retail traders normally put SLs underneath old lows and on top of old highs. So what are the high probability draws on liquidity? So obviously you've got the higher time frame draws, the 1 hour, the 4 hour. All of these draws are normally going to be high probability. Obviously, if you're aiming for a high time frame draw on liquidity, like a 4 hour or 1 hour, and you've entered off the 1 minute, there's going to be, unless you're really accurate and precise with your entries, there's going to be a lot of chop up and down. There's the lower time frame draws on liquidity are going to be much closer than the higher time frame. So obviously we got the 4 hour here. So people probably going sells here on the higher time frame out of this fair value gap, which I will go on in the next video. I'm going to record straight after this. All the swing traders trying to catch longs here or longs here, say, right? Stops above this last swing high, come down, all got stopped out with this high time frame liquidity sweep, and then we roll over. So obviously going back into like the episode 1 of psychology, patience. It's good to have patience in this market, especially with higher time frame draws on liquidity and obviously fair value gaps and everything else. It's much better to be in a high time frame PD array like a fair value gap or an order block or all these things I will go over. But it's better to have higher time frame liquidity sweep to then enter lower down to catch obviously the big reversal, so on and so forth. We also have equal lows, equal highs. So relative equal lows, equal highs. That's when the market leaves two lows relatively close together, like so. These would be relative equal lows. Relative equal. Good God, man. Relative equal lows. And then obviously we do have some actual equal lows if we can find them. Like this would be another relative equal low. Equal highs. These are equal highs. So equal highs and equal lows are all the same. They're all high probability draws on liquidity. So if you're looking for sells, if buy side's been taken like this, and you see these relative equal lows, you can assume that price will sweep these because it's generated sell side liquidity. The market's put these here for a reason to come back to then sweep, and then move on, and or sweep lower, come back up, sweep back down. So yeah, relative equal lows, relative equal highs and equal lows. They're just basically two swing lows right next to each other that hasn't swept. So if this come down and swept this would not be relative equal lows, it wouldn't be equal lows. They got to be to the tick the same or relatively the same. They're all high probability. The highest probability liquidity you can get are data highs and data lows. So obviously, this is futures market, stock market, CFD. It's all the same. There's certain news events that come out that are red folder, high impact news. When it comes out, it forces the market up, down, creates big wicks. These are known as data highs and data lows. So today, 8:30 New York time, we had, I think, CPI come out, come down, swept a little bit of liquidity, rocketed up, leaving this low behind, and then originally this high before it got swept. Now price continued up afterwards, sweeping this data high here. After the data high been swept, we tapped into a high time frame PD array. But after this was swept, you can often assume, not always, sometimes depending on the price action, price will leave data lows for another time. But I'd say a good 80%, 90% of the time, if a data high gets swept, a data low is going to get swept probably the same day. So we swept the high, manipulated back up again to eventually roll over, come back down, sweep data lows, and obviously continue a little bit lower too. But yeah, data highs, especially with NFP, CPI, and PPI, they're all very good high liquidity draws. Obviously, some people tell you to stay away from news days, don't trade news days, but actually the best days to trade is after news. Now, I don't really recommend trading before news or holding during news because obviously very, very volatile. It may not every time, but most of the time it will just wick you out because of how volatile the markets are. And when news events happen, especially high impact news, brokers will often widen the spreads, so it'll take far less to come down to sweep you out than it would normally on a normal day. So instead of like a 5 pip spread between your price and the chart price, it'll be like a 10, 15 pip spread. So the candle on your screen could be here, but because the brokers extended the spreads, it could wick you out, even though it's here, still wick you out, and then come back up, and then go to your TP. But yeah, trading after news, waiting for market to build structure to go in your direction, or whatever your bias is the best way. This is also, again, coming into the patience factor, discipline factor of episode 1. You need to combine everything I'm telling you and use every aspect to become a good, profitable trader. So yeah, data lows, data highs, they're going to be the strongest. You've also got previous day high and low. That's also a good draw on liquidity. So normally, if we sweep a previous day high, oftentimes we'll go towards their low. Most of the time. So previous day, we sweep previous day, we can often expect a reversal. Obviously, you're going to want to wait for market structure to present itself to show that we're reversing. But most of the time, if we sweep a high, we're going to come back down. Same with previous week, all-time highs even. Obviously, all-time highs is a bit different because once we're trading above all-time highs, it's hard to get take profit above because obviously there's no back past data. But yeah, obviously we've got previous week high as well. You know, like this last week, we come very close to sweeping previous week low, but we didn't need it obviously because we had elections. But a normal week we would have swept this low. Like here, we swept previous week low, created the bottom wick, come back up and retraced 164 points. Now that's a big move. Obviously it's on the weekly, so it doesn't look that big. But yeah. So if I had to rank them in order, I think obviously we'd have obviously the higher time frame draws will be some of the strongest, as well as data highs and lows. They are pretty much the strongest draws on liquidity, but then obviously we've got lower time frame draws, internal, I'll go on to this now in a minute, internal highs and lows, and then obviously we've got just normal wicks, consolidation areas. But yeah, the higher time frame, and obviously we got equal lows and highs, and relative equal lows and highs. So yeah, so probably the higher time frame draws and data lows and data highs probably the strongest, especially if you're trading intraday. You only want to be in a setup for like half an hour max. Data highs and lows when obviously there is news, high time frame news, they're probably going to be strongest. Obviously next the high time frame draws, the 1 hour, the 4 hour is what I normally look at. Obviously I do mark out the closest previous day and obviously previous week as well, because once they are swept, often we'll have reversals. And then equal highs and equal lows and relative equal highs and equal lows, they probably come under just under high time frame draws. And then obviously we got the lower time frame internal highs and lows, they probably like the lowest probability draw. Obviously they still work, but if I can see we've got equal highs and equal lows, or data highs, data lows, high time frame draw, then I'll probably target that first, and then use the lower time frame draws, the internal lows and highs, as partial profit areas where if swept, I'd take partials, bring my stops to break even, and then hold for said high time frame draws, data highs and lows, and then obviously the equal highs and lows. Right, in internal to external liquidity. Now this is I'll go more in depth on this in a future video because it kind of goes into the ICT concept. So internal liquidity, right? That is on the lower time frame, a internal. So obviously we're trading in a range, right? The swing lows inside that range are internal lows. So this would be an internal low, these would be internal lows, this would be an internal low, and then obviously the external lows would be this, really. So normally we want an internal high to get swept and target the external low, obviously depending on bias. But the external are normally the higher time frame liquidity. So obviously this would be external. It's the top of the range. So this would be external liquidity, and then this here would be also external. And then all of this is internal because it's inside this range. So this is an internal high, this is an internal high. All of these, this low resistance liquidity, this is just generated sell side. This is low resistance liquidity. So normally with low resistance liquidity, it's just a bunch of wicks stacked up next to each other that they don't sweep each other. Normally, if price comes below 1, it'll come below all of them. That's why it's low resistance, because there's not much give in holding price up. So when price comes down, it'll normally sweep all of them rather than just 1 or 2, because it says in the name, low resistance. There's not much resistance there. If it's going to sweep through these, it'll probably take external too. I can try and find a buy. So all of this here, this is all again generated buy side. Just a load of wicks stacked up against each other. Hasn't really swept. And then obviously we come up, we sweep all of them. There's not much resistance here. We sweep, 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 come up and sweep this internal high, and then continue down, come back up. Obviously, if your external liquidity draw isn't correct, then you can always just target internal. Now normally, because I am an intraday trader, I will normally only target the internals, because realistically, if you're trading intraday, you're not exactly going to be targeting 100 points. Not every day you're going to get 100 points. So targeting internal, taking partials, and then holding on to possibly take external is probably the best way to go. But yeah, so again, this would be external, this would be external because it's the top and the bottom of the range. Everything inside will be internal. And then obviously the higher time frame you go up, the further you go up, this lower time frame external will become higher time frame internal. So then this would be the external, and then this would be the external. Obviously, because you're going up in the time frames, obviously the candles they get less and less because obviously it's the higher time frame. You're only looking at the 30-minute candles instead of the 5 or the 1. So obviously it's a bigger range because it's a bigger time frame. So the externals get different. So this is now an internal, this is now an internal, this is an external, this is an external. And that's pretty much it. There's not much else to say. Next video is going to be fair value gaps. Now this is the start of the source, the concepts that I use personally: fair value gaps, inverse fair value gaps, order blocks, changing the state of delivery, and then obviously my favorite concept, market maker buy model, market maker sell model, kind of like all put together with SMT divergence and obviously macro times and all that. That'll all come in future because obviously that's a bit more advanced. But next video is going to be fair value gaps. Nice and easy, quite simple. Probably going to be a short video, fair value gaps, because it's not very hard to come around to. Yeah, that's pretty much it. I'll upload this video now, straight after last episode. Link in the description for my TikTok and the Discord. Yeah, see you later.